This is the critical hour. If you are a veteran, a military spouse, or someone who cares about the promises made to those who served, you need to listen closely. The threat isn't a sudden, massive cut announced on the evening news. The real danger is the quiet, creeping erosion of vital programs, benefits that millions rely on that are set to expire, be defunded, or drastically altered by 2026. We are talking about lifelines. We are talking about the difference between stability and financial ruin. We've tracked the legislative calendars, the sunset clauses, and the subtle budgetary maneuvers, and we have identified 7 critical veteran programs that may quietly disappear or become unrecognizable within the next 2 years. Don't assume your benefits are safe. They are constantly under review, constantly under pressure, and unless we understand exactly where the weak points are, we risk losing them forever. This isn't fearmongering. This is a necessary alert about the silent battles being fought in the halls of power, battles that determine the future security of our military community. The first program we need to talk about, the one facing perhaps the most insidious threat of dilution, is the PARBOT, Transition Assistance Program, or TAP. Chucked. Now everyone knows TAP. It's the mandatory, often frustrating, week-long seminar you sit through before separating or retiring. But the threat isn't that TAP disappears entirely. Congress knows the optics of eliminating mandatory transition training would be terrible. The real danger lies in the slow-motion dismantling of the effective components of TAP, specifically the specialized elective tracks that actually provide veterans with marketable skills and robust career planning. When TAP was reformed, it included several specialized 2-day workshops, career credentialing, entrepreneurship, and the technical skill tracks designed to move beyond the basic resume writing and provide real, actionable paths. These are the components that are quietly being targeted. They are expensive. They require specialized instructors. And they are often the first things cut when a blanket funding freeze is implemented across the Department of Defense. Think about the scale of this problem. Hundreds of thousands of service members transition every year, each bringing a unique set of skills that often don't translate cleanly to the civilian world. The core TAP curriculum is designed to prevent immediate homelessness and provide rudimentary financial literacy, but it fails to bridge the massive gap between military structure and corporate culture. The elective tracks, however, are the only thing standing between a veteran with niche, military expertise and a successful second career in a related field, like cybersecurity or logistics management. If the funding for these electives dries up, what you are left with is a mandatory check-the-box exercise that satisfies bureaucratic requirements but leaves the veteran functionally unprepared. The political argument against these specialized tracks often centers on cost efficiency. Critics argue that veterans should seek these specific trainings after separation using their GI Bill, ignoring the critical fact that effective transition planning must happen before the uniform comes off. Losing these specialized tracks means losing the vital head start that allows veterans to secure employment offers before their terminal leave even ends. This quiet disappearance, the slow strangulation of quality, is the most dangerous kind of cut because it happens without a single headline. The program still exists, but its efficacy vanishes. We must understand the legislative history here. TAP was born out of necessity, recognizing the high unemployment rates among returning Vietnam veterans and subsequent iterations, especially the reforms following the post-9/11 conflicts, aimed to make it comprehensive. But complexity breeds vulnerability. As the DoD and VA fight over who funds which component, the specialized tracks, the ones that truly cost money, become the fiscal football, easily punted into the sunset. If the current trajectory holds by 2026, TAP will be a shell of its former self, providing basic information but no meaningful pathway for the 21st century service member. This isn't just about a class. It's about the economic stability of the entire transitioning force. The ripple effect of poorly transitioned veterans affects everything from national employment statistics to rates of veteran suicide. When the government saves $1 on specialized training, the societal cost is exponentially higher down the line. We are talking about the foundational infrastructure of veteran employment, and right now, that infrastructure is cracking under the weight of budgetary neglect and political infighting over jurisdictional control between federal agencies. The fight to maintain robust, specialized TAP funding is critical, because once the funding mechanism for these optional but essential workshops is dismantled, rebuilding it requires an act of Congress, a feat of legislative effort far harder than the quiet administrative decision to simply let a grant expire. Next on our list, and one that affects the financial stability of millions, are specific VA home loan guarantee provisions. Again, the VA loan itself is not going away. It is too politically popular and too intertwined with the housing market to be eliminated wholesale. The threat here is focused on two key areas: the funding fee exemptions and the specific riders allowing zero-down financing in certain high-cost-of-living areas. Let's start with the funding fee. This fee is paid by the veteran to offset the risk of the loan guarantee to the taxpayer. It's usually around 2.3% of the loan amount for first-time users. However, veterans with service-connected disabilities are exempt from this fee, a crucial benefit that saves them thousands of dollars up front. This exemption is tied to specific legislative appropriations and is frequently targeted during budget negotiations. The argument put forth by fiscal hawks is that the VA loan program should be entirely self-sustaining through fees, and that exempting disabled veterans creates a subsidy that must be absorbed elsewhere, leading to calls to cap the exemption or tie it to a higher minimum disability rating. If Congress adjusts the threshold, even slightly, say, moving the exemption from 10% disability to 30%, millions of veterans who currently qualify would suddenly face thousands in closing costs. This seemingly small administrative change effectively eliminates the benefit for a huge portion of the disabled veteran population, making home ownership immediately unaffordable. The second major threat involves the zero-down provisions in highly competitive markets. While the core VA loan allows for 100% financing, in certain areas where housing prices exceed the standard conforming loan limits, the VA has specific provisions, often temporary or regionally targeted, to allow veterans to compete. These riders are constantly scrutinized. As housing markets shift and federal budgets tighten, these specific high-limit guarantees are often the first to be rolled back. The consequence? A veteran in San Diego or Northern Virginia who relies on that specific high-limit zero-down option suddenly finds themselves priced out of the market entirely, forced back into renting or moving far away from their established support network. The economic impact of losing these provisions cannot be overstated. The VA loan is often the only mechanism through which veterans, who frequently struggle with post-service employment stability and have lower savings rates due to frequent moves, can achieve the foundational stability of home ownership. The specific threat we are tracking is the expiration of the current authorization for the higher-tier loan limits, which is due for review. If it lapses without renewal, or if it is renewed with tighter restrictions on debt-to-income ratios that disproportionately affect veterans with existing student loan debt or high-interest credit card debt accumulated during transitional periods, the benefit quietly vanishes for those who need it most. We are talking about a legislative action that doesn't eliminate the VA loan, but renders it useless in the most economically competitive areas of the country, effectively creating a tiered system of access based on geographic location and pre-existing wealth. The lobbying efforts around this are intense, involving large banking institutions and mortgage brokers who have a vested interest in the structure of the funding fees and the overall risk profile. Veterans need to understand that the security of their home loan benefit is not guaranteed. It is perpetually under negotiation, and the most vulnerable components are always the specific exemptions designed to help the most financially fragile veterans. The legislative clock is ticking on these riders, and if they disappear, the dream of home ownership for countless families disappears right along with them. This is a battle fought in the fine print of appropriations bills, a battle that determines who gets to plant roots and who is forced to remain transient. Moving on to education, a cornerstone benefit for millions. The post-9/11 GI Bill, specifically the transferability rules and the Yellow Ribbon Program component. Like the home loan, the core GI Bill benefit is likely safe, but the vital, high-value components that make it truly transformative are at risk. The ability to transfer the GI Bill benefit to dependents, a spouse or children, was introduced as a powerful retention tool. It incentivized career service and provided a massive benefit to military families who often sacrifice career opportunities for their service members' career. This transferability is now under intense political pressure. Critics argue that the benefit is being used primarily as a family entitlement rather than a retention tool, especially for those who separate shortly after the minimum service requirement to qualify for transfer. There are ongoing legislative discussions aimed at restricting transferability, potentially by raising the minimum service requirement significantly, limiting the percentage of the benefit that can be transferred, or placing an age cap on dependent usage. If transferability is curtailed or eliminated, it strips away one of the most significant financial planning tools available to career military families. This is not a small adjustment. It fundamentally changes the value proposition of staying in uniform for 2 decades. Many service members make the decision to remain in for 10, 12, or 15 years specifically to lock in that transfer option for their children's future. Removing it silently eliminates a core promise made to those families. But the threat to the GI Bill goes deeper, right into the Yellow Ribbon Program. Yellow Ribbon is the component that allows veterans to attend expensive private, out-of-state, or graduate schools that cost more than the standard GI Bill maximum tuition rate. The VA pays the max, and the school agrees to waive a portion of the remaining cost, with the VA matching that waiver. This program is entirely dependent on voluntary school participation and, critically, on dedicated federal matching funds. The vulnerability here is twofold. First, the federal matching funds are subject to annual budgetary caps. If the number of participating veterans increases significantly, or if the overall VA education budget is frozen, the matching funds can become insufficient, leading to schools reducing their Yellow Ribbon participation or capping the number of slots available. Second, the administration of the program is complex. Universities facing their own financial pressures may quietly decide that the administrative burden and the cost of the waiver are no longer worth the federal match, leading to a silent exodus from the program. If Yellow Ribbon disappears or shrinks significantly, the vast majority of private and elite higher education institutions become financially inaccessible to veterans. The promise of the GI Bill is access to any education. Without Yellow Ribbon, that promise is severely limited to state schools and institutions charging below the national maximum. This is a vital component for those seeking highly specialized degrees or competitive graduate programs, and its erosion is a direct threat to the upward mobility of the veteran community. By 2026, the quiet withdrawal of universities from the Yellow Ribbon Program, combined with stricter rules on transferability, could leave the GI Bill intact in name only, drastically reducing its actual utility and value. The fight here is against administrative fatigue and budgetary pressure, forces that are often far more effective at dismantling programs than direct legislative repeal. We must track university participation rates and federal appropriation levels with vigilance because the silent reduction of slots is a benefit cut by any other name. Let's turn our attention now to a program that is often misunderstood but provides crucial support for the most severely disabled veterans. Veteran Readiness and Employment, VR&E, or Chapter 31, specifically the funding for non-traditional career paths. VR&E provides vocational, rehabilitation, counseling, and financial support for disabled veterans struggling to find suitable employment. It is designed to be highly individualized, focusing on the veteran's specific limitations and career goals. The threat we are monitoring involves the funding allocation for high-cost, non-traditional training. Think specialized coding boot camps, high-level technical certifications, trade apprenticeships, or entrepreneurial startup support that falls outside the standard 4-year degree model. These non-traditional paths are often the most effective way for severely disabled veterans to find flexible, high-paying work that accommodates their service-connected conditions. However, they are also significantly more expensive per veteran than simply funding a community college degree. Budgetary reviews often flag these programs as high-risk or high-cost outliers. The current legislative environment is pushing for standardized, easily quantifiable outcomes. This means programs that are hard to measure, like the success rate of a veteran-owned startup funded through VR&E, are likely to be targeted for cuts. The danger is that the VA could quietly implement tighter internal guidelines for counselors, forcing them to steer veterans toward lower-cost, traditional educational paths, even if those paths are less suited to the veteran's long-term needs or physical limitations. If the policy shifts to prioritize cost over individualized effectiveness, the core promise of VR&E, rehabilitation tailored to the individual, is broken. We are already seeing evidence of this pressure, with increasing reports of veterans having to fight harder and longer to get approval for specialized training like advanced data science courses or specific trade certifications that cost upwards of $15,000 to $20,000. By 2026, if this trend continues, VR&E will still exist, but it will be primarily an administrative program funneling veterans into standard, often inadequate, degree programs, denying them access to the cutting-edge, high-demand skills necessary to compete in the modern economy while managing their disabilities. This is a catastrophic loss for veterans seeking meaningful, sustainable careers that honor the constraints imposed by their service. The political calculus here is simple. It's easier to justify funding a standardized college tuition than it is to defend a $25,000 grant for a veteran to pursue a highly specialized, non-accredited, but highly effective technical certification. The bureaucracy prefers standardization, and standardization kills the individualized support that makes VR&E effective. The loss of this flexibility would effectively maroon thousands of disabled veterans in low-wage jobs or unemployment, undermining the very purpose of vocational rehabilitation. The legislative language around VR&E funding is often broad, allowing administrative policy decisions to dictate the scope of the benefit without direct congressional action. This is the definition of a quiet disappearance. The framework remains, but the utility is gutted by internal policy shifts. Our fifth program is critical for immediate access to care, the Chan Community Care Network, CCN coverage limits. The CCN, established under the Mission Act, allows veterans to seek medical care from private providers when the VA cannot provide services in a timely manner or when the veteran lives too far from a VA facility. This program was a massive, necessary reform, but it is also massively expensive. The VA's budget for community care has ballooned, leading to intense scrutiny and calls for cost control. The threat here is not the elimination of the CCN, but the drastic tightening of the eligibility criteria that determine when a veteran is allowed to use private care. Currently, eligibility is based on wait times, usually 20 days for primary care, or distance, usually 30 minutes driving time. We are tracking specific legislative proposals and internal VA policy discussions aimed at extending these wait times and distances. Imagine if the wait time for specialty care was quietly moved from 28 days to 45 days, or if the driving distance threshold was changed from 30 minutes to 60 minutes. These subtle changes, implemented administratively, would immediately disqualify hundreds of thousands of veterans from accessing community care. They would be forced back into the overwhelmed, understaffed VA system, facing unacceptable delays, or simply going without necessary treatment. The political argument for this tightening is framed as encouraging efficiency within the VA system and reducing reliance on expensive private contractors. But the reality is that the VA is not yet equipped to handle the full volume of demand. Rolling back CCN eligibility is essentially a denial of care by procedural mechanism. For veterans living in rural areas who rely heavily on the distance criteria to access any specialized care, a change in the driving threshold could mean that a simple checkup becomes an entire day's journey, or worse, that necessary procedures become entirely inaccessible. The complexity of the CCN billing and claims process also contributes to its vulnerability. Private providers, frustrated by slow payment and complex bureaucratic hurdles, may quietly decide to stop accepting VA patients. This provider exodus, driven by administrative inefficiency rather than legislative cut, is another form of quiet disappearance. If the network of available private doctors shrinks, the benefit is meaningless, even if the policy technically remains on the books. By 2026, the critical question will not be whether the CCN exists, but whether the eligibility rules allow anyone to actually use it. We must fight against the administrative creep that seeks to define the benefit out of existence by making it practically unattainable for the majority of the veteran population. This is a life and death issue where delays in care for cancer screenings, cardiac treatment, or chronic pain management can have irreversible consequences. The battle for the CCN is a battle for timely, accessible health care, and the enemy is the fine print of the regulatory guidelines. The sixth program might seem less urgent than health care or education, but it speaks directly to dignity and the final respects owed. Specific burial and memorial benefits adjustments. These benefits include allowances for burial plot purchase, reimbursement for funeral expenses, and transportation of remains. While national cemeteries will remain, the specific financial allowances provided to the families of deceased veterans are highly vulnerable to quiet budget freezes and caps. These allowances are often viewed by budget analysts as non-essential death expenses rather than vital benefits earned through service. The threat is simple: inflation. The cost of a funeral, burial plot, and transportation has skyrocketed. The VA allowances, however, are often capped and rarely adjusted to keep pace with the real-world costs. If the allowance for a service-connected death remains frozen at, say, $2,000, while the actual cost of a simple burial exceeds $10,000, the benefit quickly becomes symbolic rather than substantial. The family is forced to absorb the vast majority of the cost, turning a time of profound grief into a period of acute financial stress. We are tracking legislative efforts to quietly cap or freeze these reimbursements, often bundled into larger appropriations bills where they receive minimal scrutiny. Furthermore, there are specific programs related to the maintenance of headstones and markers in private cemeteries, or the allowance for transportation of remains across state lines that are funded through specific short-term grants. If these grants expire without renewal, the burden falls entirely on the family or local veterans organizations. The quiet disappearance here is the erosion of the meaningful bond's financial support. The benefit exists, but it is so inadequate that it provides negligible relief. For the families of veterans who pass away without significant life insurance or savings, these small allowances are crucial. The fight to maintain the integrity of these burial benefits is a fight for the dignity of the veteran's final journey and the financial security of their surviving loved ones. By 2026, without robust legislative action to tie these allowances to actual cost of living increases, these benefits will have quietly faded into irrelevance, leaving behind only the symbolic gesture of a flag and a headstone. The legislative silence surrounding these benefits is their greatest threat. Finally, the seventh program, and perhaps the most heartbreaking if it disappears, relates to the critical Mission Act mental health initiatives, specifically temporary grant funding. The Mission Act, passed in 2018, included several groundbreaking provisions aimed at improving mental health access, including specific pilot programs and grant funding for immediate, emergency mental health care for veterans who were not currently enrolled in the VA system. This was a direct response to the veteran suicide crisis, recognizing that many veterans in crisis had separated recently or never formally enrolled. These specific high-urgency programs, like the ability to receive emergency mental health stabilization at any community hospital, regardless of enrollment status, were often funded through temporary appropriations or sunset clauses that are now rapidly approaching their expiration date. The danger is that these specific temporary crisis intervention programs will simply lapse. The core VA mental health services will remain, but the immediate low-barrier access points designed to catch veterans before they fall into catastrophic crisis will vanish. We are talking about the difference between a veteran being able to walk into a community emergency room and receive immediate, funded stabilization care, and that same veteran being told they must wait for a VA intake appointment, which, as we know, can take weeks. The political reality is that renewing these specific grants requires dedicated political will and funding that is often diverted to the core, permanent VA infrastructure. The argument is made that the VA should simply absorb these functions, but the bureaucracy is too slow and geographically constrained to handle the immediate, decentralized demand. If these specific grant-funded initiatives disappear by 2026, the safety net for unenrolled or recently separated veterans will be dramatically reduced. The consequences are measured in human lives. The fight here is to turn temporary, effective pilot programs into permanent, mandated benefits. The quiet disappearance of these grants, often without a formal legislative vote, is a silent surrender in the war against veteran suicide. We must demand that Congress recognize the temporary nature of these life-saving programs and act immediately to secure their permanent funding before the sunset clauses take effect. The Mission Act provided the framework, but only consistent funding ensures the delivery of the promise. These 7 programs, the specialized tracks within TAP, the funding fee exemptions and high-limit riders on VA home loans, the transferability and yellow ribbon components of the GI Bill, the flexibility in VR&E for non-traditional careers, the crucial eligibility criteria for the community care network, the real-world value of burial allowances, and the life-saving grant-funded mental health initiatives are all facing imminent, silent threats. None of them are likely to be eliminated with a dramatic flourish. Instead, they face a death by 1,000 cuts, administrative tightening, budgetary freezes that fail to account for inflation, expiring sunset clauses, and policy shifts that prioritize standardization over individualized need. The common thread running through all these vulnerabilities is the reliance on specific appropriations, temporary riders, or administrative guidelines that can be changed without a formal public debate on the overall value of the program. For the veteran community, awareness is the only defense. You must understand that the benefits you rely on are not static entitlements. They are dynamic legislative creations that require constant defense. The fight for these programs is not just about money. It is about honoring the contract made with those who served. It is about ensuring that the EMI sacrifices made are met not with bureaucratic hurdles and disappearing benefits, but with the stable, meaningful support that allows veterans to thrive in the civilian world. Track these programs. Demand accountability from your representatives. Do not let the promises made to those who wore the uniform quietly fade away by 2026. The time to act is now, before the silence of budgetary erosion becomes the permanent absence of vital support.